Hi, welcome back to the Commercial Insurance channel to designing commercial insurance programs. In part 4, we're going to be diving into the whole issue of avoiding duplicate coverage. In order to have a cost-effective insurance program, you really need to make sure that the client is not paying extra insurance dollars for coverage that's already provided in another coverage form. So welcome back. Welcome back to Designing Effective Commercial Insurance Programs, Part 4, Avoiding Duplicate Coverage. Believe it or not, I often saw duplicate coverage provided in many commercial insurance programs. In one case, a client had been paying an additional $75,000 a year to purchase specialty coverage already included within our policies. Unfortunately, this condition had existed for quite some time. More recently, I was visiting a wholesale broker with a fellow underwriter. While explaining some of the programs our company offered through our MGA program, he spoke about providing property and general liability packages for a wide variety of smaller risks. Eventually, he turned to covering moving companies and explained they offered sublimits for loading and unloading exposures. Why would that be a selling point, I thought? What general liability policies do not cover, the auto policy does. Both examples illustrate duplicate coverage is often provided. Sometimes it is charged for, and sometimes it is not. It happens with large national accounts and national brokers, as well as on small accounts with small agents. Spending dollars on duplicate insurance is not a cost-effective use of the insurance dollars in any case. ISO has and continues to be the industry standard for most lines of business within the insurance industry. With few exceptions, ISO policies are almost universally recognized as the coverage of choice. Some of those exceptions include workers' compensation and employer's liability, most inland marine coverage, ocean marine coverage, excess and umbrella policies, and specialty coverages. Before we go further, the most important concept to understand about ISO policies and coverage parts is that they are very modular in nature. They all fit together. ISO goes further and designs their coverage parts to fit together with some non-ISO coverage parts, preventing coverage gaps. In particular, ISO dovetails coverage with employer's liability. As I like to say, there's a place for everything and everything in its place. The genesis of the current ISO forms dates back to 1983. I can remember when they were first being released and being reviewed by stakeholders. They were called ISO Simplified Forms. For those of you who are relatively new to the insurance industry, that nomenclature may seem a bit humorous, but compared to the forms they were replacing, they were much simpler. The simplification was more about how coverage is structured rather than the actual wording of the forms. Prior forms and rating algorithms used to develop premiums were much more complicated. If I had to use a word to describe the forms, I would borrow the term a la carte from the hospitality industry. Every policy had to be individually designed by adding an assortment of available coverage forms to create the final insurance policy. For instance, on a general liability policy, you had a long list of coverages to choose to add to your policy. On the surface, it may seem like a great idea to have everything on a pick and choose basis. It would give agents and underwriters maximum flexibility to design the product from the ground up. However, the truth of the matter is it created a high potential for error by forgetting to select certain coverages. The reason I'm diving into the past is not to try to impress you with the level of my experience. Rather, it is to provide perspective on the current forms that are being used today. ISO changed the focus from a narrow coverage form, which required adding coverage to customize for the final policy, to a more comprehensive form with options to delete to customize for individual insured needs. The prior forms were developed under individual silos with little consideration made to coordinate with other insurance policies. For instance, the general liability coverage wording did not necessarily coordinate with commercial auto policies or workers' compensation policies. The net result was potential coverage gaps which increased the need for manuscript forms. The result of increased reliance on manuscript forms reduced standardization of coverage within the insurance industry, which also opened the potential for uncovered losses and errors and omission claims. As the ISO developed their simplified form, they strove to develop a broad, comprehensive coverage form that dovetailed with companion forms to prevent coverage gaps and errors. In addition, they wanted coverage forms that could easily be adapted to changing conditions. For the most part, they were successful in achieving those goals. Perhaps the most important concept to understand about ISO coverage forms is that the forms are very modular in nature. In theory, you could pull one carrier out from an insurance program, plug in a different carrier, and the coverage would not vary. The new carrier's coverage should fit into the program just as well as the prior carrier and not precipitate coverage gaps. That is, of course, assuming the new carrier did not want to slap on new exclusions. ISO has designed their coverage forms to fit neatly together to form a comprehensive and effective insurance program. Coverage forms dovetail with both ISO forms and non-ISO coverage forms such as workers' compensation. The general liability coverage form sort of wraps around other coverages, touching all the other coverage forms, finishing the insured's primary insurance to provide a comprehensive protection plan that sits on top of the insured's level of risk retention. I'm going to demonstrate this point by looking at an example. Perhaps the best single example is how the general liability and auto liability policies fit together like jigsaw pieces. Let's take a look at the auto, aircraft, and watercraft exclusion on CG0001. The first paragraph of the auto exclusion is clear. The general liability policy is simply not going to cover BI or PD resulting from cars, planes, or watercraft. It even extends the exclusion to apply to loading and unloading. The second paragraph further broadens and solidifies the exclusion of autos, aircraft, and watercraft. Claims arising from these sources are simply not intended to be covered at all by the general liability policy. The loading and unloading hazard is defined in the definition sections of this policy. The auto exclusions extend to loading and unloading of vehicles. Based on the definition, the exclusion starts when objects are on the auto, watercraft, or aircraft. The exclusion continues while the property is on board and until the property is finally delivered to a place. The exception is while the property is being moved by a mechanical device, not a hand truck, that are not attached to the auto, watercraft, or aircraft. For comparison, let's look at how the business auto coverage form dovetails with the general liability exclusion. The wording is relatively simple and straightforward. The delineation is clear. Coverage under the business auto coverage form does not begin until the property is accepted by the insured and in place on the vehicle. Coverage does not cease until it is delivered. Exclusion 8 further explains the business auto coverage form does not cover handling of property by mechanical devices, not including hand trucks, that are not attached to the vehicle. If you have been paying attention, you have probably noticed how nicely the general liability coverage form and the business auto coverage form fit together. Losses are going to be covered by one of the two coverage forms. If it just so happens the claim occurs as the crane lowers the property onto the truck, the insurer can rest comfortable somebody, or maybe both, will respond. You will find similar dovetailing when you compare general liability exclusions to workers' compensation policies. In addition to that, you'll also find exclusions coordinating with first-party coverages as well, which brings us to a brief discussion of exclusions. With the exception of specific underwriting exclusions that are added at the underwriter's discretion, there are really basically 5 reasons for ISO exclusions. Number 1, the loss potential for the events are too large for any single insurance carrier to handle, such as nuclear incidents or war. Activities that are considered illegal. 3, they represent more of a business risk rather than an insurance risk. 4, the losses are not fortuitous, things such as rust and inherent vice, or they are intentional losses. The reasons for basic ISO exclusions are not about excluding losses or not covering claims. Rather, they are about defining boundaries or not covering claims that cannot be insured against. Hence, with a broad review or approach, almost every loss exposure should be able to be handled effectively with ISO coverage forms and/or its array of available endorsements to customize a commercial insurance program to any specific client need. You should exercise great caution when modifying ISO policy language. You may be creating duplicate coverage and perhaps making the client's program less cost-effective by incurring additional premiums for those modifications. That brings us to the end of this video. I hope you found this helpful. In the next video in this series, we will be talking about insuring exposures with the most appropriate insurance product and making sure that coverage is designed to benefit the insured rather than others. If you found this video helpful, please be sure to like it and subscribe to future videos. If you have any questions about the subject matter in this video, please leave them in the comments section below or email us at richard.uwresource@cox.net. Remember to like this video and subscribe to our channel.